Financial markets. We all know that finance is essential for running a business. An entrepreneur needs finance to establish a business, to run it, to modernize it, to expand or diversify it. He may require funds to buy assets like machinery, factories, trademarks, patents, technical expertise and so on, as well as to run day-to-day operations of business like buying supplies, paying bills, salaries, collecting cash from customers and so on. Thus, the availability of adequate finance is vital for the survival and growth of a business. In an economic system, we find two different sectors: household sector, who saves money, and business sector, who needs money for the purpose of production or sale of goods and services. Now the question is that how do these two sectors meet and transact with each other? It is the financial market which acts as a link between these two different sectors. It facilitates this function by acting as an intermediary between the savers and investors of money. Funds from households can be allocated through two different ways: via banks or via financial markets. Households may deposit their surplus funds with banks, who in turn could lend these funds to business firms. Alternately, households may buy the shares and debentures offered by a business using financial markets. Functions of financial markets. Let us now see the main functions of a financial market. A financial market facilitates the transfer of savings from savers to investors. A financial market provides pricing information resulting from the interaction between investors, who represent the demand, and households, who represent the supply in the market when they trade the financial assets. It provides liquidity to financial assets by presenting a mechanism for easy sale and purchase of financial assets. It helps to save time, money and efforts that both buyers and sellers of a financial asset would have to otherwise spend to try and find each other. Types of financial markets. A financial market consists of two major segments: money market and capital market. Money market. A market that deals in financial assets with a maturity of less than 1 year is known as money market. The market does not deal in cash or money, but provides a market for credit instruments like bills of exchange, promissory notes, etc. These credit instruments are used by business units, other organizations, and the government to borrow funds in order to meet their short-term requirement. Most of the money market transactions are taking place on telephone, fax, or internet, as money market has no physical location. The Indian money market consists of Reserve Bank of India, commercial banks, cooperative banks, non-banking financial companies or NBFCs, and financial institutions like LIC, GIC, UTI, just to name a few. The Reserve Bank of India is the regulator of the money market in India. Money market instruments. Money market deals in credit instruments like treasury bill, commercial paper, call money, certificate of deposit and commercial bill. These instruments meet short-term requirements of the borrowers and provides liquidity to the lenders. Treasury bill. A treasury bill or zero coupon bond is a promissory note issued by the RBI on behalf of the central government to meet the short-term requirement of funds. Treasury bills are short-term securities that mature in 1 year or less from their issue date. Treasury bills are highly liquid instruments and have a short yield and negligible risk of default. Treasury bills are issued at a price less than their face value and repaid at face value. The difference between the issue price and the face value of the treasury bill is the interest receivable on them and is called discount. These bills are available for a minimum amount of 25,000 and in multiples thereof. These are available both in the primary market as well as secondary market. Banks, financial institutions and corporations normally play a major role in the treasury bill market. Some interesting facts. Commercial paper. Commercial paper is a short-term unsecured instrument issued in the form of a promissory note. Commercial papers are transferable by endorsement and delivery with a fixed maturity period. These can be issued for a maturity period of 15 days to 1 year. Commercial papers are issued by large and creditworthy companies to raise short-term funds for working capital requirements. Commercial papers can also be sold at a discount and redeemed at par. These are actively traded in the secondary market. Call money. Call money is short-term finance, repayable on demand, and its maturity period varies in between 1 day to 15 days. Call money is a method by which commercial banks borrow from each other to maintain the cash reserve ratio fixed by the Reserve Bank of India. The interest rate paid on call money loans is known as the call rate. The rate is highly volatile as it varies from day to day and sometimes even from hour to hour. Certificates of deposit. Certificates of deposit are short-term unsecured negotiable instruments issued by commercial banks and special financial institutions or SFIs to individuals, cooperatives and companies. Certificates of deposit is a promissory note in the form of a certificate entitling the bearer to receive interest. It can be issued in any denomination and are freely transferable from one party to another. The maturity period of certificates of deposit ranges from 91 days to 1 year. The holders can withdraw funds on demand only after the payment of certain penalty. A quick look at history of certificate of deposit. Commercial bill. A commercial bill is a short-term negotiable self-liquidating instrument which is used to finance the working capital requirements of firms. It is a bill of exchange drawn by the seller or drawer of the goods bought on credit on the buyer or drawee of the goods for the value of the goods delivered. These bills can be discounted with a bank if the seller needs funds before the bill matures. These trade bills are called commercial bills when they are accepted by commercial banks. Capital market. A market which deals in medium and long-term funds, both debt and equity, is termed as capital market. The market is an institutional arrangement for borrowing medium and long-term funds and which provides facilities for marketing and trading of securities. The capital market consists of development banks, commercial banks, and stock exchanges. The capital market can be divided into primary market, secondary market. Primary market. A company issues shares and/or debentures to establish new business or to expand the existing ones. A market where a company gets listed for the first time to issue new or fresh securities is known as primary market or new issue market. Primary market consists of arrangements that facilitate the transfer of investable funds from savers to companies. The investors in this market consist of banks, financial institutions, insurance companies, mutual funds, and individuals. A company may use the following methods to issue securities in the primary market: initial public offer, rights issue, EIPOs. Initial public offer. Initial public offer or IPO is the first-time issue of securities by a company. A company may make IPO through any of the following methods: public offer through prospectus, offer for sale, private placement. Public offer through prospectus. Public offer through prospectus is the most popular method of raising funds by public companies in the primary market. Under this method, a company issues a prospectus and invites the general public to apply for its securities offered. A prospectus provides details about the company and proposed issue. It makes a direct appeal to investors to raise capital through an advertisement in newspapers and magazines. Public issue involves a large number of intermediaries like bankers, brokers, and underwriters. The issues may be underwritten and are also required to be listed on at least one stock exchange. Offer for sale. Under offer for sale method, a company does not issue securities directly to the public, but it sells all securities to an intermediary known as issue house at a fixed price. In turn, the intermediary resells the securities to the investing public at a higher price. Private placement. Under private placement method, a company allots its securities to institutional investors and some selected individuals. This method enables the company to raise capital more quickly than a public issue. A company which cannot afford to raise resources from the public issue may opt for this method. Right issue. Under right issue method, a company offers new shares to its existing shareholders in proportion to the number of shares they already possess. The shareholders may either accept the offer for himself or assign a part or all of his rights to another. The company offers these rights to the shareholders at a price below the current market price. E-IPO. Under E-IPO method, a company may issue capital to public through the online system of the stock exchange. For this, the company has to appoint SEBI registered brokers to accept applications and place orders, and a registrar to the issue having electronic connectivity with the exchange. The company can apply for listing of its securities on any exchange other than the exchange through which it has offered its securities. The lead manager of the company coordinates all the activities amongst intermediaries connected with the issue. Secondary market. An organized market where securities are traded after being initially offered to the public in the primary market and/or listed on the stock exchange is secondary market. The secondary market is often termed as stock market or stock exchange, as it provides a place for the purchase and sale of existing securities such as shares, debentures and bonds, government securities on a regular basis. It is the secondary market that controls the price of the stocks, as a majority of the trading is done here. The major players in the secondary market are the ones in the primary market, that is, merchant bankers, mutual funds, financial institutions, individual investors, as well as the stockbrokers who are members of the stock exchange who facilitate the trading. Functions of stock exchange. Let us understand some of the important functions of a stock exchange. 1. Stock exchange provides a place where listed securities are bought and sold regularly and conveniently. It gives the investors the chance to invest and disinvest as and when they want. This lends a high degree of liquidity and marketability to existing securities. 2. A stock exchange facilitates the determination of prices of securities according to the fundamental law of supply and demand. 3. A stock exchange maintains a complete record of all stock transactions and supplies regular information on the prices and sales volumes to the press and other media. This enables an investor to take quick decisions on the purchase and sale of interested securities. 4. Stock exchange transactions are conducted amongst its members only, with adequate transparency and according to the existing legal framework. This provides a high degree of safety to dealings and investment at the stock exchange. 5. A stock exchange market channelizes savings into the most productive investment avenues as the brokers resell or trade their securities as and when required. This leads to capital formation and economic growth in an economy. 6. A stock exchange facilitates better allocation of funds as market transactions divert the flow of funds from the less profitable to more profitable enterprises. 7. A stock exchange provides sufficient scope for speculative activity within the provisions of the law. It is generally established that a certain degree of healthy speculation is essential for liquidity and price continuity in the stock market. Trading procedure on a stock exchange. Let us take an example for a better understanding of the trading procedure on a stock exchange. ABC Company Limited enjoys high investor confidence and there is an anticipation of an upward movement in its stock price. More people would want to buy this stock, that is, high demand, and very few people will want to sell this stock at current market price, that is, less supply. Therefore, buyers will have to bid a higher price for this stock to match the ask price from the seller, which will increase the stock price of ABC Company Limited. On the contrary, if there are more sellers than buyers, that is, high supply and low demand for the stock of ABC Company Limited in the market, its price will fall. In earlier times, buyers and sellers used to assemble at stock exchanges to initiate a transaction. But now, most of the operations are carried out electronically and the stock markets have become almost paperless. Investors can trade freely from their home or office, over the phone or through the internet. Investors may approach stock exchange registered brokers also for securities trading. Stock exchanges in India. The first organized stock exchange in India was the Bombay Stock Exchange or BSE in Mumbai. There were a number of unorganized stock exchanges that used to function in the country without any formal setup and were known as curb market. The Government of India passed the Security Contracts Regulation Act in 1956 for the recognition and regulation of stock exchanges in India. There are 23 stock exchanges in India at present. Among them, the most prominent stock exchanges are National Stock Exchange or NSE in Mumbai and Over-the-Counter Exchange of India or OTCEI. National Stock Exchange. Let us start with the National Stock Exchange. With the liberalization of the Indian economy, it was found inevitable to lift the Indian stock market trading system on par with the international standards. Based on the recommendations of the Fairvani Committee, the National Stock Exchange was incorporated in 1992 by Industrial Development Bank of India, Industrial Credit and Investment Corporation of India, Industrial Finance Corporation of India, all insurance corporations, selected commercial banks and others. The NSE was recognized as a stock exchange in April 1993. Trading at NSE can be classified under two broad categories: wholesale debt market and capital market. Wholesale debt market segment offers a trading platform for a wide range of fixed income securities like central government securities, treasury bills, state development loans, bonds issued by public sector undertakings, floating rate bonds, zero coupon bonds, index bonds, commercial paper, certificate of deposit, corporate debentures, and mutual funds. Capital Market segment offers an efficient and transparent platform for trading in equity, preference shares, debentures, exchange-traded funds, as well as retail government securities. NSE has set up a nationwide, fully automated screen-based trading system. The trading rights are with the trading members who offer their services to the investors. NSE was set up to establish a nationwide trading facility for all types of securities, ensure equal access to investors across the country through an appropriate communication network, provide a fair, efficient and transparent securities market using electronic trading system, enable shorter settlement cycles and book entry settlements, meet international benchmarks and standards. Over-the-Counter Exchange of India or OTCEI. The other prominent stock exchange is Over-the-Counter Exchange of India. The traditional trading mechanism prevailing in the Indian stock markets gave way to many functional inefficiencies such as absence of liquidity, lack of transparency, unduly long settlement periods and Benami transactions which affected the small investors to a great extent. To provide improved services to investors, the Over-the-Counter Exchange of India or OTCEI was set up by the country's premier financial institutions: Unit Trust of India, Industrial Credit and Investment Corporation of India, Industrial Development Bank of India, SBI Capital Markets, Industrial Finance Corporation of India, General Insurance Corporation and its subsidiaries, and Can Bank Financial Services. OTCEI is a fully computerized, transparent, single-window exchange which commenced trading in 1992. The exchange was incorporated under the Companies Act 1956 and was established on the lines of NASDAQ, National Association of Securities Dealers Automated Quotations, the OTC exchange in USA. In the OTC exchange, a buyer or seller walks up to an OTCEI counter, taps on the computer screen, finds quotes and goes for purchasing or selling if the prices meet their targets. The OTCEI aimed to provide quicker liquidity to securities at a fixed and fair price, liquidity for less traded securities or that of small companies, a simplified process of buying and selling, and easy and cheaper means of making public sale of new issues. Securities and Exchange Board of India, SEBI, on 12th April 1988, the Government of India established Securities and Exchange Board of India as an interim administrative body to promote orderly and healthy growth of securities market and for investor protection. SEBI was to function under the overall administrative control of the Ministry of Finance of the Government of India. SEBI was given a statutory status on 30th January 1992 through an ordinance. The ordinance was later replaced by an Act of Parliament known as the Securities and Exchange Board of India Act 1992. SEBI was established to regulate stock exchanges and the securities industry to promote their orderly functioning, protect the rights and interests of investors, particularly individual investors, and to guide and educate them. Prevent trading malpractices and achieve a balance between self-regulation by the securities industry and its statutory regulation. Regulate and develop a code of conduct and fair practices by intermediaries like brokers, merchant bankers, etc., with a view to making them competitive and professional. SEBI performs various functions for the regulation as well as development of the Indian stock market. As a regulator, SEBI registers brokers, sub-brokers and underwriters in the securities market, registers collective investment schemes and mutual funds, regulates stock bankers and portfolio exchanges and merchant bankers, prohibits fraudulent and unfair trade practices, controls insider trading and takeover bids and imposes penalties for such practices, calls for information by undertaking inspection, conducts inquiries and audits of stock exchanges and intermediaries, and levies fees or other charges to carry out the purposes of the Act. For the development of the securities market, SEBI facilitates education to investors, facilitates training to intermediaries, promotes fair practices and code of conduct of all self-regulatory organizations, and conducts research and publishes information useful to all market participants. SEBI has been restructured and rationalized due to considerable expansion in the range and scope of its activities. SEBI performs its activities through 8 divisions and departments. Each department is headed by an executive director. The head office of SEBI is in Mumbai with regional offices in Kolkata, Chennai and Delhi. The regional offices attend to investor complaints and liaise with the issuers, intermediaries and stock exchanges in their respective region. SEBI also formed 2 advisory committees, Primary Market Advisory Committee and Secondary Market Advisory Committee. These committees advise SEBI on various matters. A quick look at a few of them. The committees are non-statutory in nature and SEBI is not bound by the advice of the committees. In a nutshell, any marketplace where buyers and sellers participate in the trade of assets such as equities, bonds, currencies and derivatives is termed as a financial market. Financial markets are essential for fundraising. Through the financial market, borrowers can find suitable lenders. A financial market consists of 2 major segments, A. Money market and B. Capital market. While the money market deals in short-term credit, the capital market handles the medium-term and long-term credit.